I want to show you how to sell a put spread by showing the structure of it on this whiteboard. So when you have an option chain, you have calls to the left and you have puts to the right. And the horizontal line down the middle is what is called the at the money line. And the vertical line that's down the middle is where the strikes are normally at. So on this call side, we have the 100 strike, the 110, the 120, and the 130. On the put side, we have the 100, the 90, the 80, and the 70. So when you're selling a put spread, you always sell the nearest to at the money put and buy the furthest from at the money put. So in this case, we're gonna sell the 90 and we're going to buy the 70. So the 90 is the strike that's closest to at the money. This is the at the money line, as we discussed. So I'm selling the 90 and I'm buying the 70. This is a 20-point wide put spread. And when you're selling a put spread, you want the market to go up. You want the market to go up. You always win if the market goes up after you sell your put spread. But you can also win as long as the market doesn't go below your short strike. In this case, the 90. As long as it doesn't go below that 90 strike on the put side, you win. This is the structure of selling a put spread.
So let's dive a little deeper into selling a put spread. I will discuss how to sell a put spread on the TastyWorks platform and on the Thinkorswim platform. However, before we do that, I want to discuss the option chain a little bit more because it's important to understand the option chain when buying and selling options. Once again, you have calls to the left, and then this is the at the money line as we discussed. And on the call side, below the at the money line is considered in the money, the ITM. And above that line is considered out of the money, the OTM. And then on the put side, below the at the money line, it's considered out of the money. So it's the opposite of the call side, the OTM. And then above it is in the money. So it's important to know when you're trading something at the money, in the money, or out of the money. It's very, very important because it's about probabilities, and when you're selling something in the money or you're selling something out of the money, it's a big difference in those probabilities. So to move on, also on the option chain, wants you to be aware of the open interest. Open interest just means how many options were bought and sold at a strike price. So in this case, this is the put side because it's the right side of the option chain. And over here is the call side. So how many calls were bought and sold at a strike price. Right here we have the ask and the bid, and that is also on both sides. The ask and the bid is basically where you can buy and sell at. So on the ask, that's where you can buy it. The ask is where you can buy it. The bid is where you can sell at. Okay, so the bid is where you can sell at. The ask is where you can buy at. So you want to understand those different things. The next thing I want you to understand on an option chain is delta. Delta is very, very important, and here on this option chain we have it set up on both sides. Delta is an option Greek. It's one of the four main option Greeks, and delta is the most important option Greek, especially when trading the Dorian Way, because we initiate trades at a delta level, we adjust at the delta level, we hedge at a delta level, we take profits at a delta level. So delta is very, very important for the Dorian Way, but delta should be important for any option trader, regardless if you're trading the Dorian Way or some other way. Delta is very important. Delta determines your directional risk and it determines your probability. So when I mean directional risk, I mean delta indicates how much you're going to lose based on every 1 point move. So if you are long 100 shares and that whatever you long in, that XYZ goes up 1 point, then you make 100 points. But if you're long, that means you want the market to go up. So your directional risk is to the downside. So if it goes down 1 point, you lose $100 because you own 100 shares, and every point that it goes up, you make 100, and every point it goes down, you lose 100. So that's what it means by directional risk. And it also, as I mentioned, means your probability of success. So if you have a delta of 50, and that means at the money, that's that at the money line here that's shown on the TastyWorks platform, that orange line here. If you're at the money, that means you have a 50-50 chance. That's like flipping a coin. So when you buy a stock, that is when you have a 50-50 shot. You want it to go up because you are long, you are bullish that stock that you bought. So you want it to go up, and it's a 50-50 shot. So when you're buying at the money and selling, it's the same type of probability, 50-50. But when you are selling something out of the money, that's when the probabilities change from buying. So if you're buying something, let's say something like the 40 delta, right? If you're buying something at a 40 delta, that means you have a 40% chance of making money when you're buying something at a 40 delta, because the market has to go down before you win. It has to come to you before you win, okay? If you are selling something at a 40 delta, then that means you have a 60% chance of making money at expiration, at least 1 cent. You have a 60% chance of making money because the market has to go all the way down before you lose. When you're buying, it has to go all the way down before you win. When you are selling, it has to go all the way down before you lose. And that's on the put side that we're discussing. So the probabilities change when you're selling something out of the money and when you're buying something out of the money. When it's at the money, then it's pretty equal, 50-50 shot. All right, so let's move on and jump into talking about the strikes a little bit more. So because the strikes are important. These are the strikes that are down the middle, and strikes are standardized. And what I mean by standardized, I mean everyone can buy and sell at the same strike, regardless of where they're at in the country or in the world. So if someone is in China, India, or the Philippines, and they're trading the SPX, which we are trading here, the SPX is the S&P 500 index, it's the cash settled index. If someone's trading that in a different area, they'll see the same strikes because those strikes are standardized. And standardized strikes makes it very, very easy for people to be able to buy and sell. Everyone can buy and sell at it, and they're very, very liquid because it's all on an exchange and it's all standardized and it's backed by a clearing firm. You can buy and sell options that are over the counter, but that's when you have counterparty risk because you're buying from that firm. Let's say you go to a Morgan Stanley or a Goldman Sachs and you want to sell a non-standardized option, then they will create that for you, but they are your counter risk. But when you are buying and selling in the open market on exchanges like the NASDAQ or the New York Stock Exchange, those are standardized and they backed by a clearing firm, so you don't have to worry about the counterparty risks, and everyone sees the same strikes. So I often get the question is, how can I sell something I do not own? Everyone understands that you can buy something you do not own. Well, you can sell options because you can buy and sell at the strike. They're standardized, and you have someone that's always taking the other side. So if you don't have another retail investor or institution, you have a market maker taking the other side when you are selling options. So if you buy it, you have someone selling it to you. When you sell it, you have someone buying it, okay? And the market maker is the last person, last resort. They will buy or sell from you. And they don't have to buy at your price, but they do have to buy or sell from you. They don't have to buy or sell at your price that you're looking for. And that's why sometimes you'll see the bid and ask spreads really wide. So looking at here, circling this is a 70-point bid and ask spread. Sometimes you might see something larger than that. Sometimes you might see it less than that. But if the markets are volatile and there's a lot of stuff going on, those spreads would be really wide because the market makers have to take the other side, and they want to make sure they can protect themselves the best they can, and they protect themselves by doing a wider spread. So the strikes are where you can buy and sell. And looking at this 28.50, if you are the buyer of the 28.50, let's say on the put side, because we're talking about selling a put spread today, and the put side once again is this right side. If you are the buyer of a put, you have the right but not the obligation to sell the SPX at that price. So in this case, the 28.50. You have the right, but not the obligation. But if you are the seller, you have the obligation to buy at that point. You have the obligation. So if you sell an option at the 28.50 using the same strike, and it goes down through your strike, or the buyer decides to exercise their right, then you would have the obligation to buy at the 28.50. We believe selling is better, but the seller does have the obligation to buy when we're talking about puts. So a put and a call, we're talking about puts today, but all options, standardized options, represent 100 shares. So if you buy one call or one put, that equals 100 shares. If you sell one put or sell one call, that represents 100 shares as well. So it's key to understand that. It's key to understand this option chain. Understand, once again, the at the money, in the money, out of the money, the strikes, the bid, the ask, the open interest, and the delta. Once you understand those things, you can successfully move forward in understanding how to sell different option strategies. So today we're going to be discussing the selling of the put spread. And let's jump into that now. So when selling a put, the Dorian Way, when dealing with regular T margin, and that's the regular margin most people get, we sell out of the money and we sell at the 10 delta. And we're usually just buying a 10-point wide spread, selling a 10-point wide spread. But a put spread can be a half a point wide, or it can be thousands of points wide. A put spread just equals 2 put legs. So you're buying and selling one, or selling and buying one. So a put spread cannot be less than 2 puts, and it cannot be more than 2 puts. So a put spread is 2 puts. In this case, we are selling a put spread. We are selling the closest to at the money put and buying a put lower. So in this case, we're just demonstrating this with a 10-point wide spread at the 10 delta. So in this case, we're selling the 26.55, and we clicked on the bid to do that. And we're buying 10 points lower, which is the 26.45, and we're clicking on the ask, because when you click on the ask, you're buying. So we're clicking on the ask, and this is a 10-point wide put spread. And this is how you do it on the TastyWorks platform. If we jump over to the Thinkorswim platform, it's the same type of concept. We're looking at the SPX still. And if we go down to the 10 delta on the Thinkorswim platform, and we sell the 26.50, and we're going to buy the 26.40, and that's just clicking on the ask when you buy. So once again, this is a 10-point wide spread, and this is how it looks on the Thinkorswim platform. All right, so if we jump back to the TastyWorks platform, we're going to look at this selling of a put spread on the curve view. All right, so this is how it looks on the curve view. It's just basically saying that if the market, the SPX, stays above the 26.55, which is your short strike here, then you're going to win. You're going to win as long as it stays above that strike. Okay, as long as it stays above that strike. All right, and your max loss would be at your strike that you bought. Okay, that's where you lose. After it passes this strike, your short strike, which is the 26.55, you lose. You lose going that way. So when you're selling a put spread, you are bullish. And bullish means you want the market to go up. Bearish means you want the market to go down. So in this case, you want the market to go up. But the great thing about this is that the market can go down. It can go down as long as it doesn't breach your short strike. As we discussed before on the whiteboard, the whatever you're trading can go down when you're selling something out of the out of the money. In this case, we're selling the 10 delta. You want it to go up, but it's okay if it goes down, as long as it doesn't breach your short strike. And if it does breach your short strike, you still have a little buffer based on the amount of premium you initially received. So let's say you received $100 and you sold at the 26.55. Well, you don't start losing until the 26.54 because you have that $100 buffer. Once again, options equal 100 shares and each point equals $100 when you're dealing with standardized options. When you're dealing with futures options with the Dorian Way primarily sales, that's a different ballgame. But just to give you the framework on how to sell a put spread, we're going over it in regular T margin because that's what everyone usually gets when they start to sell options. All right, so let's break down how far this put is from at the money. So when you're breaking down how far something is from at the money, you have to take the short strike, in this case, which is the 26.55, and you have to subtract it from the last price, what the at the money price is, or the last price of that product you or underlying you are trading. And then you divide it by that last price again. So in this case, you take 26.55 minus 28.79, and that equals negative 244, and you divide that by 28.79, and then that equals 7.7%. So almost 8% down this market would have to go before you lose on this trade. So the market would have to go down almost 8% for you to lose on this put spread. That is how a put spread is structured. It's a great type of strategy because you do have a hedge, you have a max loss that you can deal with. So in this case, if you received, let's say, $50 on the spread and you did a 10-point wide spread, your max loss is 950 because it's 100 points for every point. It's $100 for every point. So if it's a 10 points, it's 100 times 10 is 1,000. You minus the premium you receive. So if you receive $50, your max loss is 950. If you receive $100, your max loss is 900. You can avoid that max loss by doing adjustings or getting out at once your short strike is breached. There's a lot of different ways you can avoid a max loss. We will discuss that in more educational videos in the future. So that is the selling of a put spread.